Welcome back to Risk Manager's Corner. Today we're talking about something every business, investor, and risk analyst needs to understand: financial risk. It's one of the most significant risk categories in any enterprise, and if you don't understand it, you're flying blind. So in this video, we'll break down what financial risk is, the types you need to know, how it's measured, and most importantly, how to manage it like a pro. Let's dive in. Financial risk is the possibility of a negative financial outcome due to uncertainty or exposure. That could be anything from a customer failing to pay, to interest rates going up, to cash drying up when you need it most. Here's the thing: every financial decision carries risk. When you lend, invest, borrow, sell on credit, hold inventory, or take on long-term contracts, you're exposed to financial risk. Some risks are internal. Others come from the outside world. But if the outcome could hurt your cash flow, profitability, or capital position, it's financial risk. Why does this matter? Because financial risk directly impacts your company's ability to survive and grow. It determines whether you meet your financial obligations, whether you stay solvent, and whether investors continue to trust you. Here's a quick example. A profitable company with poor liquidity management can still go bankrupt if it can't pay suppliers or employees on time. On the other hand, companies that manage financial risk well can survive economic shocks, outperform in downturns, and build long-term resilience. It's not just about protecting downside. It's about unlocking strategic confidence. Let's now break down the main types of financial risk. Market risk: the risk of financial loss due to changes in market prices. This includes interest rate risk, foreign exchange risk, equity risk, and commodity price risk. Credit risk: the risk that a borrower or counterparty won't repay their obligations. This is a major concern for lenders, but also applies to any business offering credit terms. Liquidity risk: the risk that you won't have enough cash or funding to meet short-term obligations. Even profitable businesses can fail if liquidity is mismanaged. Operational risk with financial consequences: these are internal failures, fraud, system breakdowns, errors that end up causing financial loss. We'll look at each of these in more detail next. Market risk is driven by movements in financial markets. Let's say you've taken out a loan with a variable interest rate. If rates rise, your financing costs go up. Or maybe you're an exporter. If the currency strengthens, your goods become more expensive overseas and you lose competitiveness. Market risk can be broken into two parts. Systematic risk: this affects the entire market, like a stock market crash or global interest rate hike. Unsystematic risk: this affects a specific industry or asset, like oil prices impacting energy firms. Companies manage market risk using hedging strategies, like derivatives, swaps, or forwards, or by diversifying exposure across geographies or asset classes. Credit risk: credit risk is one of the most common and expensive forms of financial risk. At its core, credit risk is the risk of non-payment. A borrower defaults. A customer doesn't pay their invoice. A counterparty fails to settle a trade. Credit risk has three main dimensions. Probability of default, PD. What are the chances they won't pay? Exposure at default, EAD. How much will you lose if they don't? Loss given default, LGD. What's your actual loss after recoveries? Credit risk is managed through credit checks and scoring, setting limits or caps, taking collateral or guarantees, using credit insurance or factoring. The goal is simple: avoid lending money or extending credit where the risk of default is too high. Liquidity risk. Liquidity risk is often misunderstood, but it's one of the fastest ways a business can get into serious trouble. There are two types of liquidity risk. Funding liquidity risk: you don't have enough cash on hand to pay your bills, even if your business is profitable on paper. Market liquidity risk: you have assets, but you can't sell them quickly without taking a big loss. Examples: a property developer may have millions tied up in land, but can't make payroll. A bank with high customer withdrawals but no immediate funding sources can collapse in days. Managing liquidity involves cash flow forecasting, holding liquid reserves, diversifying funding sources, setting up lines of credit as a buffer. Good risk managers always know. Profit is theory, cash is real. Operational risk with financial impact. Let's not forget, some financial losses come from internal failures. Examples include a trader entering a fat finger trade worth millions, a system outage during billing cycles, fraudulent expense claims or procurement fraud, misreporting financial data. While these are classified under operational risk, they result in real, measurable financial impact. That's why operational risk is a financial risk in disguise. Controls like audits, reconciliations, segregation of duties, and automation reduce the likelihood and cost of these events. Measuring financial risk. So how do you measure financial risk? Here are some of the main tools and metrics. Value at risk, VAR. This estimates the maximum potential loss over a given period with a certain confidence level. Scenario analysis. You model worst-case scenarios and see how they affect your balance sheet or cash flow. Stress testing. You simulate adverse conditions, like a market crash or a credit crisis, and check your ability to survive. Sensitivity analysis. You test how small changes, like a 1% interest rate move, impact your results. The goal isn't to predict the future. It's to understand your vulnerability and prepare. Managing financial risk. Managing financial risk isn't about eliminating risk. It's about aligning your exposure with your risk appetite, what your business can tolerate without compromising its goals. Common tools include hedging, using derivatives to offset price fluctuations, diversification, avoiding concentration in one market, customer, or instrument, limits, setting exposure caps at portfolio or counterparty level, insurance, transferring risk to a third party, policies and governance, documenting how decisions are made, monitored, and escalated. Good risk management is proactive, not reactive. It's not just the CRO's job. It's embedded into finance, strategy, operations, and leadership. Financial risk is the heartbeat of enterprise risk. If you're managing a business, running a project, lending money, or investing, you're managing financial risk whether you know it or not. The winners aren't the ones who avoid risk. They're the ones who understand it, measure it, and manage it better than everyone else. Subscribe to the Risk Manager's Corner for weekly content that makes risk practical. Drop your questions below. We always respond. Be sure to like and subscribe, and see you in the next video. Stay sharp and manage smart.